Many investors think market losses happen because of bad timing or luck, but the real reason is often emotional decision-making. Fear, anxiety, and panic can override rational planning and cause people to sell at the worst times or miss opportunities for growth. In this video, you will understand why emotions hurt returns and how to build strategies that keep your decisions calm, disciplined, and profitable. Like and subscribe to learn systems that protect wealth and improve long-term results. 1. Understanding emotional investing. Emotional investing occurs when feelings such as fear, greed, or excitement drive decisions instead of data, strategy, and logic. Investors may buy assets during hype or sell during declines, ignoring fundamentals. Decisions are reactive rather than proactive. Fear is the most destructive emotion because it leads to selling at low points when markets are volatile. Emotional investing reduces long-term returns because markets reward patience and consistency. 2. Fear during market downturns. Fear is strongest during market declines when losses feel immediate and threatening. Investors may panic sell to avoid further losses, locking in temporary declines as permanent mistakes. Short-term fluctuations can feel larger than they are because losses are psychologically amplified. Fear can override rational planning, especially for inexperienced investors. Historically, markets recover over time, but emotional exits prevent participation in the rebound. 3. Greed and overconfidence. Emotional investing is not only about fear. Greed and overconfidence also distort decisions. Investors may chase trends, buy assets at inflated prices, or take excessive risk to maximize short-term returns. Overconfidence leads to ignoring fundamentals and underestimating volatility. The combination of fear and greed creates cycles of buying high and selling low. Emotional control mitigates these extremes. Investors who remain disciplined benefit from opportunities without exposing themselves to unnecessary losses. 4. The cost of reaction. Every emotional reaction has a financial cost. Selling during a downturn locks in losses, while buying impulsively at market peaks exposes capital to high risk. These reactions accumulate over time, reducing total returns significantly. Emotional investing often creates the illusion of action, but it is often counterproductive. Long-term growth is rarely achieved by reacting to headlines, noise, or short-term price swings. 5. Behavioral biases. Fear-based investing is reinforced by cognitive biases. Loss aversion, herd behavior, and recency bias all amplify emotional responses. Loss aversion makes losses feel larger than equivalent gains. Herd behavior pushes investors to follow the crowd, buying or selling without independent analysis. Recency bias causes overreaction to recent events, ignoring long-term trends. Emotional investing is rarely rational because these biases skew perception and decision-making. 6. The role of patience. Patience is the antidote to fear in investing. Markets fluctuate naturally, and short-term declines are inevitable. Long-term investors who remain patient avoid selling at temporary lows and benefit from recovery and growth cycles. Patience is supported by systems such as allocation, diversification, and regular contributions. These systems remove decision pressure during volatile periods. Emotional control and patience combined allow compounding to work effectively. 7. Building rules-based strategies. Rules-based investing is the most effective way to prevent emotional decisions. Predetermined plans for asset allocation, contribution, rebalancing, and risk management remove subjective choice from daily volatility. Rules ensure investors do not act on fear or excitement. By automating decisions or following strict guidelines, emotional impulses are bypassed. This disciplined framework keeps portfolios aligned with long-term goals even during extreme market conditions. 8. Diversification and risk management. Diversification and risk management are structural defenses against emotional reactions. Balanced portfolios reduce extreme swings that trigger panic. When investments are spread across assets, sectors, and geographies, losses in one area are offset by stability in another. Predictable risk exposure allows investors to remain calm. Emotional triggers are minimized because portfolios are designed to withstand volatility. Risk management is not about eliminating uncertainty, but about designing a system where fear does not force irrational decisions. 9. Long-term perspective. Fear often comes from focusing on the short term rather than the bigger picture. Market fluctuations are temporary, while long-term growth depends on time in the market. Emotional investors zoom in on declines, amplifying panic. By maintaining a long-term perspective, short-term noise becomes manageable. Understanding that downturns are part of market cycles helps investors stay invested. Perspective provides context, reduces stress, and reinforces adherence to disciplined strategies. Long-term thinking converts fear into patience, enabling steady compounding. 10. Emotional control as wealth protection. The most powerful tool against fear is emotional control. Investors who master their reactions protect returns, build confidence, and strengthen portfolios. Emotional control allows systems such as allocation, diversification, and rules-based investing to function as designed. Markets reward discipline, patience, and rational decision-making. Fear reduces returns, but controlled behavior preserves them. Wealth is not just accumulated through smart investments, but protected through mental resilience. Emotional mastery transforms markets from a source of stress into a tool for consistent growth. Emotional investing proves that the mind is as important as capital. Fear, panic, and overreaction destroy returns, while discipline and patience build wealth steadily over time. By creating systems, following rules, and maintaining perspective, investors protect both capital and confidence. Emotional control allows markets to work in your favor rather than against you. Like and subscribe to continue learning strategies that remove emotion, safeguard your portfolio, and strengthen long-term financial growth.